Welcome to this webinar today on US reporting and financial planning for UK assets. Welcome everybody that's joining us live, and thank you to those that are looking over the recording post-event for all the questions that you've submitted. My name's Steve Eakins, and I'll be your host this evening. I work at a specialist currency firm helping people move money internationally. Thank you for joining, as I say, and tonight we have a couple of real experts in their fields, a panel that will be introducing to you in a moment to go through the questions that everyone has submitted up to the event. Now, we want the webinar to be as interactive as possible for everyone, so if there are questions and queries you have as we go, there is a live function for you to be able to submit questions live right now, and we'll try and get through as many as we can. I must do a little disclaimer that we've had lots and lots of interest in the event, which has been fantastic, so much so that we'll probably be running another one as part of the series. We'll go through as many of the questions as we can today, but apologies if we don't get to yours. Post-event, again, as this event is being recorded, we'll be sharing this around, and you'll also have the contact details of everyone who's contributing so that you can approach us directly for that one-to-one conversation and free consultation on service, and to see how we can help you personally a little bit further. Right, to get started, I'm going to introduce you to these two experts, both Rob and Jim, in a moment, to introduce themselves and their service, and then we'll go into some frequently asked questions that a lot of you have been submitting before we go into the FAQs, but hopefully you find this useful and engaging and a bit of fun from all of us this evening. So first, over to yourself, Rob. Welcome, and thanks for giving up your time today.
Yeah, thank you, Steve, and welcome everybody to the webinar. I represent a company called SJB US. We are a cross-border financial advice specialists. We mainly work with Brits and individuals in the US that have either left behind assets in the UK, need advice surrounding what to do with them, either financially or working with Jim from a tax perspective. And yeah, we do holistic planning to ensure that individuals are making the right decisions for their long-term financial goals and retirement plans.
Thank you very much.
Hello. Hello, everyone. I'm Jim Cassidy. I work with the firm of tax director with Abidos. We are based in Coral Gables and a few other offices in Florida. I have over 30 years international tax experience, and I assist clients with tax planning as well as tax compliance, preparing all informational returns for international and foreign assets, and dealing with all issues of working with the IRS and resolving any other issues that tax compliance issues that you may have. So again, thank you for your time.
Thank you very much. Now, regarding myself, I work at a firm called Lumon, and we're a specialist currency brokerage firm that's been helping people move money internationally, making those payments quick, easy, and secure for 25 years. I'm personally on year 16 now of helping people do this globally. We're 200 people across almost 10 offices. Our 10th office opens up next month. And we last year transacted about 8 billion sterling's worth of capital. This year we're on course for 11. Really what we're doing here a lot for people is helping people financially plan around the risk mitigation involved in currency exchanges, which we'll go into a bit today. But in real terms, for example, the cable rate, so the pound-dollar rate, has moved by over 4.5% in just the last 6 weeks due to interest rate forecast change. So when you're talking about future planning, financial wealth planning, investments, and indeed investments that you're looking at living off, you need to protect yourself against that currency risk, which is why I'm here this evening and will be answering questions on that topic. But again, yeah, thank you everyone for joining us today. Into the questions. Again, we have had a lot, so thank you everybody. Saying that, if there's any live questions, please feel free to submit them to us today. What we've done to start with is there's been a big series of themed questions. We've started to collate a few of them together. So first I'm going to be going to Rob, which has been some questions that people have been asking. In summary, this is, what should I do with my UK pension, and can I access it from the US?
Yeah, I think this is probably the biggest question that I get from individuals moving over to the US. And again, I guess it's a two-part question there. So first of all, short answer to the second part of the question, if you can access it from the US, is yes. But ultimately, you have to dig a bit deeper into how you can actually access that. In the UK, you've got two different types of structures. You have a final salary pension, or sometimes called a defined benefit scheme, Those are kind of the more old school pensions, which are often accumulated before the year 2000, 2002, which is kind of when they started kind of dying out. You then have the kind of more newer schemes called defined contribution, which is the most common one we see nowadays, where you put X amount of your salary towards the pension, and your employer, if you're lucky, would match those contributions as well. And you can access both of these in different ways. Defined benefit schemes is essentially guaranteed income, which you can just get into your bank account at the retirement age, normally around 62, and you can just obtain that and of course access that normally as you would any other type of asset. With a defined contribution pension, it becomes a little bit more tricky. Reason being is it can be very scheme dependent on how you can actually access that money. And these are, I think, some of the biggest issues that we find helping people plan and advise surrounding UK pensions. Reason being is your options become a little bit more limited when you become a non-UK resident. So, for example, I had a client a couple of weeks ago. He had a UK defined contribution scheme. It was actually a personal pension, but it was an employer set up one. Now, he was actually told that he could access that scheme flexibly. So, he could dip into it whenever he wanted, of course, after the age of 55, which is the minimum age in the UK. Once we actually dug into it deeper and obtained some of the scheme documents, we actually found as a non-UK resident, he was not able to access that flexibly. And I think this is a common theme that we find, is that individuals can't actually access their defined contribution pensions flexibly. The other two options that they often give is either take it as one lump sum. So at the age of 55, you might get a bit of an ultimatum, which we've seen, countless times, where the pension provider will say, okay, you can either leave it with us and not have access to it, or you can take it as one lump sum. Of course, as Jim will probably come on to later on, if you take it as one lump sum, of course, because the pension is taxed as income, you're going to be hit with quite a large tax bill. So not very tax efficient when it comes to that option. So what options do you have? Well, you can look at transferring, consolidating them into different types of a different type of UK personal pension, which might be more suitable for somebody in the US, which I'll come on to a little bit later on.
Thank you. As I said, there's lots of questions on that topic, so we hope that's been useful. Please do keep the questions coming. Next point on it was, can I claim both US and UK state pension? There was quite a few that asked that question, Rob, so if you can give some details on that, that would be appreciated.
Yes, so again, yes, you absolutely can. You've built up and paid Social Security in both of those countries, for a number of years. The UK and US systems work slightly differently. With the UK, it's just based on, how many years that you've essentially worked and paid in. US, it's more based on your earnings and credits that you built up. Essentially, when you get to retirement, let's say the age of 67, you can claim both. But what is something that is often unseen by people is something called the windfall elimination provision. Don't get your head in the sand when it comes to the jargon there. Essentially, it just means that you might get a reduction in your US Social Security if you draw on a UK state pension. Essentially, if you have less than 20 years of earnings within the US and you claim a UK state pension as well, then the US actually has the ability to reduce your monthly income by around $560 per month. So the planning here comes around whether it is worth taking a UK state pension if you're going to get that maximum reduction. If you have over 20 years, then the reduction goes on a sliding scale up to 30 years. So if you have more than 30 years in the US, you don't have to worry about that reduction because it doesn't apply to you. But anything below 30, there may be a reduction. So the planning here is surrounding, okay, how much are you going to get from your UK state pension? And is it worth taking it based on the reduction that you might get from the US? So yes, you can take both, but planning needs to be surrounding what the best options are regarding taking one or the other or both. If that helps.
Now, what I should read here as a bit of a disclaimer is bear in mind that every situation is different, every personal circumstance is different, so you should really be approaching this one-to-one with the respective specialist you want to appoint to have that conversation. Everyone here is willing to do that, so just do make sure that you engage with us post to make sure that you get ahead of these things that we're going to be going. The next and last one for you, Rob, before I come to you, Jim, please, is I live in the US. Can I hold sterling investments, and what options do I have?
Yeah, okay. So this, again, I think this is something that I get a lot from Brits, especially people that have, that have ISAs, that have cash in the UK. They don't necessarily want to move it over to US dollars. They like keeping some form of, home currency, whether that be for when they go home and want to spend money, or they just like having, the diversification of two different currencies. The options here become a little bit more limited again because you're in the US. You need to be aware of something called PFIC rules. So PFIC essentially is a punitive taxation by the IRS on any essentially foreign mutual funds, ETFs, things along those nature. Think of it about any type of fund outside of the US. You can pretty much guarantee it'll be under PFIC rules. What that means is there might be punitive taxes on any sale or gain on that type of asset. So the option is to keep it into GBP become slightly more restricted. So what you can do, of course, you can keep cash. The way to get around PFIC rules, if you want GBP investments, is to really invest directly into stocks or bonds. So that way, because it's not under the PFIC rules, because it's not a mutual fund or ETF, you're able to essentially invest directly into GBP investments in the UK if you have a provider that will allow you from the US to be able to do that. Of course, you can invest into property. But yeah, mainly surrounding the PFIC rules, really only direct stocks and bonds are the options that you have to ensure that you're not going to get punitive tax from the IRS.
Thank you very much. Hope that's useful for a majority of the audience because there was lots of questions on those topics. Same thing for yourself, Jim, please. Quite a few questions have come through, which we piled together. Hopefully this means that it's useful for a lot of people in the audience today. So first one for you is, can I transfer the funds in my UK pension to a US IRA or to my 401k?
I get that question quite often, and unfortunately the IRS hasn't kept up with the rest of the world, and there is no portability for US pension plans. You'd think they would wake up someday and say, hey, this might be a good idea to allow foreign pension plans that are in treaty countries, for example, to be rolled into, transferred directly into an IRA or 401k, but unfortunately that's not possible. So there's no rollover provisions. On the other side, for US purposes, if you do take a IRA distribution to contribute that to a Roth IRA, although that's taxable here in the United States, that transfer is not taxable, I believe, in the UK. So again, there's all sorts of planning that we need to put in place. Also going back to taking pension distributions while living in the US from UK pension plans. Generally under the treaty, and the US has a really good treaty with the United Kingdom, and distributions from UK pension plans generally are only taxable in the United States. So the objective here is to take your UK pension distributions 100%. So you have a distribution of $1,000, you will get £1,000, you will get £1,000. And what is needed to be done is ensure with Robert, the pension trustee, that you have a UK NT code, non-taxable code. And the IRS actually has a very good procedure, and it works, to obtain this NT code, because sometimes if this code is not present, the trustee will issue the distribution and withhold 25% UK tax. We don't want that, because then you will need to go back and file a UK tax return and get a refund. And then you have a timing issue because the distribution is taxable in the United States. So to avoid these headaches, there is a procedure. There's an IRS form, and the number is 8802. There's an HMRC form 2002. And basically you fill those out, pay a fee, submit those to the IRS. And it seems to be working. The IRS will issue a residency certification. You'll get a copy as well. And the IRS is kind enough to send that information to HMRC. I know, Robert, I don't know what your experience is, but I'm hearing it takes a few months for the UK to get their anti-coast processed.
Yeah, I think a few months is has been generous, to be honest. Yeah, I mean, I've got a number of different clients taking pension benefits at the moment. A lot of the times you can't obtain the NT tax code unless you actually have some form of taxable income, so they can't start it until that begins. So we often take a small amount of taxable income to kickstart that process. But yeah, we're seeing 6 to 12 months. You know, people sending letters, chasers. Yeah, so again, the sooner that individuals can obtain this or start the process to obtain it, the better off they'll be in the long term.
Right. So plan ahead.
Plan ahead, yeah, absolutely.
See, there's a theme in the advice you'll get from the panel today. Planning ahead is very important to avoid pitfalls, certainly. Next topic is, Jim, is around, well, again, UK tax, but in this one, it's how do I ensure no UK tax withholding on my UK pension distribution?
All right. Now we've essentially just went over that. We need to file those forms, the 8802 and the HMRC 2002 forms. Again, plan ahead. If you're thinking of taking a distribution come January of next year, or sometime next year or later this year, let's get those forms into the IRS as fast as we can. And hopefully this procedure will be recognized. One solution I had one client, because the funds are going to be distributed in the next few months. I'm not sure exactly if this worked. I'll follow up, but I said, well, let's show the trustee the application that you've completed, that you've sent to the IRS. Maybe they will accept that for now. That you're just awaiting, you're applying for your residency certification. Maybe this is enough to substantiate not withholding UK tax on your pension distribution.
Thank you. Now, there was a lot of conversations and the questions that we got around the tax implications in the US around UK real estate. Now, there's a couple of questions that we'll come on to that have been submitted, which are a bit more particular, but just as a bit of a summary, Jim, because there was quite a theme on this around the implications for US tax planning. Can you just give a little bit of a summary for the audience, please, on the key considerations?
Sure. Well, under US tax rules, real estate in general is provided very good tax benefits. Like the UK, if the home was your principal residence, there is an exclusion for the gain. In the US, as long as you've lived in the US property 2 out of 5 years. And this applies to UK property as well. So I know if you relocate to the US and you are going to plan to sell your primary home, in the US we have a time limit. You need to sell that property within 5 years. So as long as you've lived in the property 2 out of the past 5 years as your primary home, the first $500,000 of gain for a married couple is tax-free. For a single person, it's $250,000. And that applies to UK real estate. It's not just US specific. Under US tax rules, for rental property, the US is much more generous in terms of allowing for rental expenses. I believe in the UK, certain rental expenses are limited, like mortgage interest and depreciation, and some other expenses are capped and limited. In the US, that is, all the expenses are permitted. Even your travel back to the UK home to manage the property is deductible. So in many cases, the rental activity of a UK property, your former primary home, or another rental property may result in a US loss for tax purposes. We get depreciation, all the expenses, utilities, insurance, property management, depreciation, just straight line over 30 years, will result most likely in the US possibly a loss or a lower net profit than in the UK. So if the UK does tax the rental activity because there is a profit for UK purposes, we also in the US get a credit for the UK tax. So from a US perspective, UK real estate may not result in any significant US tax.
Thank you for the summary. Right. Next is onto a few currency questions that I'll be answering myself. So I know from an audience perspective, it sounds a bit daft that I'm asking myself questions here, but hang with me here. And then we'll go into some lots of questions that have been submitted, and we'll go through as many of those as we can. Thank you to those that have submitted questions live in the event as well. We'll try and get to them as we go, but feel free to keep them coming and we'll get through as many of them as we can. From a currency perspective, the questions that were coming in is, there seemed to be a bit of a theme as to why would I use a currency broker over a bank or my local bank. I think a lot of US citizens haven't necessarily come across our industry before, so this is probably where it comes from. In the nicest of ways, the benefit of a currency brokerage or a specialist currency firm is offering better rates and better service than your bank. So in essence, this is, in the nicest of ways, if we couldn't add value or save money, we wouldn't be in business. So look at it in that way and bear that in mind when you get to moving money internationally, and importantly planning that. If we couldn't save you money, respectively, we wouldn't be here as a business. Are there any costs of using the service? No, there is not. So using a facility with a currency broker it's cost free. There's no transfer fees and bits and pieces from that. How our industry makes money is the difference between where we buy and where we sell our currency, so it's built into the exchange rate that's quoted. And if a client decides to take that and transact, that's the all-in cost. There's no other hidden fees or invoices that come 30 days thereafter. Any minimum volumes was another question that came up a fair amount, i.e. I'm doing my pension planning and I've got a few thousand to transfer over. Is it worth using a broker? The answer to that is you can, yes. We facilitate transfers from thousands to millions at a time. Obviously, those savings on those volumes vary quite a bit from a numeral perspective, but even if you're planning on making pension withdrawals, the saving between us and the banking world might be a very nice lunch or dinner out every month. So it's worth investing in 20 minutes time to set that up so you can have that meal out on our saving. How best do I plan forward and manage the moving of currency exchange rates? Now this one, I could probably take the whole hour up to discuss, to be honest. So I'm just going to highlight what this really means. And people who have been planning and watching this last 30 days in particular has been very volatile in the currency market. This is the changing view around interest rate forecasts, which obviously come into wealth planning as well, right? Has an impact on the returns. But with the US planning on cutting rates steeper than the European market and the UK central bank, it means that the US dollar has been, in essence, weakening. So people have been taking funds out of the US dollar to try and get a better return elsewhere. That people selling the US dollar is making it weaker and therefore cheaper to buy, but more expensive to sell. So that's another advantage of using a specialist currency brokerage firm over that of your bank, because most banks will simply go, here is the rate, take it or leave it. Whereas using a broker, it's, here is the better rate over that of the bank, but equally, here's the rates, here's the themes, here's the trends that are impacting the currency market, so you can make a more informed decision as to how you plan. To put that into numbers stake, because I think numbers normally tell a good story here, right? If you were looking at making a £1 million investment in the UK or in a UK investment, you're getting it's $80,000 more expensive now than it was just 6 weeks ago. So quite a shocking bit that can really impact those plans. And that kind of comes into the other bit. What are the impacts of the currency aspect coming up which could impact the movement? In essence, that theme of question was, will the rates go back again? Will I get the gain back with my dollars? And at the moment, the expectation and the view is that probably not. There won't be a reversal of that kind of speed that we've seen the cost, but it's something to be incredibly aware of. And that's probably part of the other theme of questions that we've had, i.e. why the three of us here today, where does the connections come? And as you can probably tell from our blended services, if you're using one of us in this community, you'll probably find value in all three of us, from a wealth planning, from the tax implications from it, and also the global currency transfer. So if you're engaging in using one of our services, you'll probably find a real benefit in the other two that's here today. Hopefully that's useful. As a quick summary, because I know time is running out, we've only got another half an hour and we've got plenty of questions to go through, but if you've got more questions, we will try and prioritize the ones that are coming in live today, so keep them coming. Questions wise, so we'll try and get through as many as we can. Again, I need to do this disclaimer piece that every circumstance is different, so we'll try and make some sweeping assumptions here as we answer these as quickly as we can for you. For your personal circumstance, do reach out to us directly, and post-event we'll get in contact for some feedback, good, bad and differences, and equally to see if we can facilitate and add any value to you in your circumstance. So a series of questions here for you, Jim, first, if you don't mind. So this is coming from Celine, which is, what's the latest foreign tax news for US residents? So what's the latest themes and news, Jim? What's going on at the moment that people should be aware of that they might not have caught?
Right. Well, I think the trends now is more in transparency and reporting. I see the IRS has some, they call them campaigns, and they're focusing more on international activities and international trusts. All financial assets outside the U.S. Have some form of U.S. reporting, whether you have an interest in a foreign partnership, corporation, and a trust. These investments have reporting issues attached to them. These reporting rules were developed to avoid an unfair tax deferral, or parking assets outside the United States and then deciding when to take the money in, and basically dictate to the IRS when you're going to pay the tax. So the IRS has put in place all of these onerous reporting regimes, and the IRS has been an uptick on looking at foreign pension plans. They had a campaign looking at Malta pension plans, foreign trust reporting. So they see there are approximately 9 million U.S. citizens outside the country. And also they looked at the amount of real estate or LLCs that are owned here in the U.S. by foreign nationals. And when they look at the receipts for U.S. estate tax and filing of other forms, they're quite low. So they've increased their focus. They're saying, well, with this amount of activity, we should have this amount of taxes, and it's not there. So that's what we may see going forward. And in this Malta pension investigation or a campaign that the IRS led, they essentially took, all these reporting forms have codes and country codes, and they did a data mine and pulled out all of these assets that have Malta attached to them. So I think that what we need to do is ensure that we have tax compliance. I know there's a lot of issues in the press. The IRS went out and hired 80,000 new auditors. They just announced in their international tax group that they've hired several thousand new agents. I don't like to hear that news, because I'm like, well, I'm going to have, knock on wood, I have not had that many audits, and I do not see an uptick in audits, but I think we just need to ensure that you're working with Robert and myself to ensure that any UK assets and investments, we're reporting them. That does not mean that you're going to pay excessive US tax. Again, most of these assets we can do some planning to ensure that they're tax efficient, just like real estate. We just want to ensure that if there's a knock on, we ever get an IRS notice, we can easily respond and resolve any issues that the IRS may ask in the future.
It's always an interesting one, isn't it? Always brings back a memory that I have that people in the audience might not have heard too much around, but people probably remember the news broke around Greece going bust, and the government was really keen to look at ways of increasing taxable revenue. And in Greece, you need to pay a tax if you have a swimming pool. So they did an audit for it, and apparently there was only 11,000 people with swimming pools in the whole of Greece. So out came Google Maps, and off they went to go and get some more taxable revenue. But yeah, there's always a theme of focus. It's the difference between policies and action, isn't it? Kind of their focus cast, but yeah, always relevant. Thank you. Well, we've still got loads of questions to go through, so again, we'll try and keep each answer to about a minute. But again, if you want details on your personal circumstance, please do let us know. Jim, next one for you, one that came in from Peter. Specific details on QROPs and the latest IRS tax requirements for filing, and how variable types of withdrawals are treated by the IRS. Now, I don't know quite how you're going to answer that one in 60 seconds, but have a go.
Well, they haven't. I know there was some proposed regulations that were issued, and the IRS is focusing on pension plans that are funded by U.S. residents with U.S. assets. And there's a difference between those multi-pension plans and QROPs. I don't think the IRS is there yet. They don't understand it. They issued these regs almost 2 years ago now. They've done nothing with them. So under the Malta Treaty and under the UK Treaty, the QROPs qualifies as a pension. Generally, it was funded with foreign employment. It meets all of the other criteria that the IRS does not like on other foreign pension plans. So the trend is, if you've been reporting your pension all along for the past almost 10 years now, when the QROPs start early 2013, 2014, that's when I first started dealing with it. So there haven't been any new developments. They haven't finalized the regulations. So kind of the trend is just continue treating your QROPs as you have done consistently over the past several years. Hopefully you've been reporting those on your FBAR and your forms 8938 or a form 3520. And we're just waiting to see how the IRS is going to handle these and they're not up to speed on all these other foreign pension plans.
Next one, still staying with QROPs, May. This is one that came in from Lindsay, if you're in the audience tonight. Any information or advice to help me figure out if my QROPs will count as a pension in the eyes of the IRS?
All right, so again, in these proposed regulations, it appears the QROPs is being treated as a valid pension plan. There is a new agreement between the UK and the US and Malta, which is this CAA that was issued a couple of years ago. But again, the QROPs was funded with employment. It was funded and structured in the good way that the IRS wants. It's tied to earnings, and it's from a former UK pension plan. So I think what we've been doing is continuing to treat the QROPs as a pension plan. The earnings inside the plan grow tax-free, and then we can look at planning for taking distributions.
Thank you. Next one's from Kate, and there's a theme on this a little bit later as well, but handling inheritance from UK relatives as a US passport holder.
Well,
I guess it's a massive topic, but yeah, do your best for 60 seconds, please, Jim.
Sure. Well, inheritances, beneficiaries, gifts and inheritances for the US are tax-free. So there is no taxation. If you inherit $100 million from your grandfather in the UK, it's tax-free here in the US. There is just a reporting requirement. If it's $100,000 or more, you need to file a form 3520 and just report to the IRS, I received cash of $100 million. That's it. That's all you have to do. It's part of the form 3520. Under US inheritance rules, you also get a step up in the value of the asset that's transferred from the UK. So if the value of a home, let's say real estate in the UK is $1 million at the date of death, the value of that property in your hands, the US passport holder, is $1 million. So if you were to sell it tomorrow for $1 million, essentially you pay no US tax. Because in the US rules, it's the donor is the decedent who pays the estate tax, not the recipient.
Great.
I add on just a little section on that. So what I've also found from an inheritance point of view, specifically for pensions anyway, a lot of my clients, inherit UK relatives' pensions. Now, it's a little bit different with kind of pensions than it is a lot of other assets, where there's something called a death tax in the UK. Now, correct me if I'm wrong, Jim, I don't know if that applies in the US, but if you die before 75, then actually that money can get passed on tax-free anyway, like it would, with kind of what Jim was mentioning, the US beneficiaries and IHT there. But if it's over 75 and it gets passed down, then any distributions from that would be normal income tax, which again would just be distributions into the US. So that's where, again, a little bit of planning needs to be adhered to, because if you, for example, the person that does pass away and you don't have a beneficiary pension, the whole pot of money might actually get liquidated, and then the beneficiary might then have to pay income tax on that full amount. So it's important to ensure that the scheme that you're in, the pension scheme that you're in, actually has a beneficiary pension attached to it. So if you pass away, the money can just continue to be invested, and you can, or your beneficiaries can then take distributions as and when they need it, rather than getting stung by a large income tax liability. So that's something, again, that a lot of people are unaware of with these workplace pensions, that they don't have these beneficiary options. So that's, again, one of the key reasons that we see people transferring to a more personal arrangement where it can pass on through generations, rather than just stopping at first death and then shifting the buck onto the beneficiaries to pay the tax, which ultimately, I don't think any beneficiary would want to do or pay, let's say.
Right, the inheritance of a foreign pension plan, there aren't really good rules that are in place to address that. There are for inherited IRAs, and the IRS does have rules on when you take distributions, but those rules do not apply to a QROPS or to a SIP. So if that's the case, again, you need to get together. You need to get together with Robert and myself so we can figure out the U.S. tax implications of inheriting a deferred comp pension plan for the UK. It's a bit different.
Yeah.
I'm going to come to both of you on this next one, but should I move my QR ops from Malta or leave it where it is? Impact for both of you on this one, I think. So who wants to put their puts in piece?
Yeah, so I think, well, me and Jim, I think, have had conversations about this previously, haven't we? I think you've got a bit more of an IRS hat on where you understand those rules. For me, I'm looking at, from a wealth planning perspective, is it better to just be in the UK, be under FCA, regulation protection, or is it worth keeping it in Malta? And I think what we essentially concluded was that we don't want to open up a can of worms here by transferring it back into the UK and perhaps creating more of a headache for clients, potentially another liability coming down the road if a transfer becomes taxable, or going back into lifetime allowance type rules in the UK for higher net worth individuals. So I think Jim would agree that we kind of concluded it was best to just leave things as they are until we find out a bit more about this IRS campaign, and then obviously if there's planning to get ahead of that, then of course we can do, but at the moment it's advised to kind of sit tight and just make sure it's invested correctly in the QROPS.
Right.
Great. Next one for yourself, please, Jim. One from David. Some planning around my situation with double taxation relief on source of funds, such as pensions and annuities.
So as I think we covered earlier, there's a good treaty with the UK, and generally, if you are a US resident, non-resident of the UK, the pension distributions are only taxed in the United States, not the UK. So we again want to ensure that we do avoid withholding at source by getting this NT code in place. But if not, like for example, on real estate, there may still be some tax to pay in the UK on the sale of property. Under US domestic law, as well as the treaty, you are allowed to claim a credit for the UK tax. So the reason there is a tax treaty is to avoid double taxation. In many cases, there is no double taxation. The IRS will allow a credit for the UK tax. And even if, let's say the UK tax is at 25% and the US effective rate's at 20, you didn't get to use all of the UK tax as this 5% extra tax that you haven't credited in the current year. Those get carried forward for 10 years. So you don't lose UK taxes that you paid as a credit in the US. There is a carryover. And in your particular situation, we can look to see the planning of what carryover taxes you may have. It's also important if you're repatriating to the US and you've spent many years in the UK, you should have a very large foreign tax credit carryover that we can plan with. So again, it's something we need to look at closely.
A few questions have coming in live asking around having a copy of the webinar. Apologies to those that we are racing through or trying to race through fairly big topics in quick time for everybody, but don't worry, everyone will get a copy of the event after. Just let us know by replying on the email that you'll get post-event with our contact details, and we'll get a copy of the event over to you if we've been talking too quick for you to make notes of the comments. Right, Jim, back to you, please. This was from quite a few people, David, Kate, John, and a couple of others. What do I need to know about tax liability from acquiring inherited funds and property from the UK while I'm a US tax resident? So what happens to a US tax resident if they're inheriting funds, which may or may not include property? But there was, as I said, 3 or 4 people that were asking that question.
Right. So again, the receipt of the inheritance, cash, and property is not a taxable event for US purposes. Again, if it's 100,000 or more, there is a reporting requirement. So we need to file this reporting on a Form 3520, which is generally due at the same time as your tax return, to disclose gifts and inheritances from foreign sources. As long as we
give the number again for the audience, please. A few questions come. Make sure they note it right.
It's a Form 3520, 3520. And it's also a form that the IRS looks, it's actually a form for foreign trusts. And with some pension plans do fall under, like a UK SIP. And there's specific rules for treaty exempt pension plans like SIPs. In some cases, they're not required to be reported on this form. But if you looked at this 4 or 6-page form, you're going to see all of this information on foreign trusts. And the last page is an area where you just report your gifts. So as long as you report those, again, you get a step up in the value. Cash comes in tax-free, market value of the property as well. And you would report that on your Form 3520. So if the IRS ever asks, you sold a house for $1 million and you paid no tax? You bought it for, your basis was $1 million? Yes, I filed Form 3520 IRS, and you have that information in your records.
One from Barry, but a few others asked a similar kind of question related to this property. So we're both US and UK citizens. We have pensions and a flat in the UK. How do we best plan to get the funds to the US and mitigate the tax over the coming years? So there's a point there probably for you, Jim, from a tax perspective, and I'll equally be able to add a comment from a currency planning perspective as well. But Jim, you go ahead first.
Right, so we would need to look at very specific information. What is your investment in the property? What would be, I've done these analysis before, where you look to see what would be the gain in UK purposes. What would be the UK tax on that gain? Compare that to what would be the US tax. Again, we have foreign currency fluctuations, because when you purchased that home, maybe in 2012, the pound was much more stronger than it is now. So maybe in some cases, you might have a US dollar loss. So again, it's very specific. We want to see what the tax implications are on both sides of the pond. I work with pension planning. We'll also work with Robert to see what assets you have in the US that are tax efficient. You know, do we take 25% tax-free out of your QROPs or your SIP? So we can look to see what baskets of income you have that are tax efficient. We draw those down now and kick the high tax stuff that can down the road for future years. But hopefully, maybe rates, I don't know if rates are going to go down. They're supposed to go up in 2026, but at least we can kick that down the road, get some cash now. Right, we have some inflationary issues. Stephen, I think you can touch upon, Robert.
Yeah, I love it. I think this is a really good question, really, because it summarizes in a real life scenario. If you're in this situation or coming to this situation, when all 3 of our services will be of real benefit for you to get the most out of that asset from a planning, tax perspective, and from managing the currency transfer around that. Now, with the currency markets moving as much as they have done, as I mentioned previously, 6% movement in 6 weeks can make one big difference. If the property is £1 million, right, can make a really big difference. So engaging with all of us early makes a big difference. The other little thing that we've got is 2024 is the year of elections, and with elections comes potential change around the world, with Europe's going to the polls, the UK's gone to the polls, the US is going to the polls. So Things that are happening now, maybe I should make a note on here of the date we are saying these things, because if you're watching this back in 3 months' time, it might be a bit different. But hey, something to consider for going forward. Rob, I'm going to come to you for a few of these here now, please. So I've got an ISA and not sure what to do with it. Bit of an open here question, to be honest, Rob, but do your best as you can. I'm also conscious we've only got 10-15 minutes left, so we'll try and power through some more of these. It looks like we won't be able to answer all the questions we've got, but we'll try and do our best. If you're in the audience live and want your questions asked now while we're live, please submit them into the chat and we'll prioritise those. But over to you, Rob. I've got an ISA, not sure quite what to do with it.
Yeah, I think, I mean, I'll try and answer this as quickly as possible. So I probably would say you should have done something with it before you left, which I guess is the theme of this whole webinar. You should have been looking at these things.
No, that doesn't count as advice here, Rob. Yeah.
Hindsight is a good thing. Essentially, if you've got an ISA, it comes back to what we were mentioning earlier with the PFIC rules. So if you hold investments, etc., in there, GBP, mutual funds, and you buy and sell these investments, well, you might be taxed punitively on those. So you kind of have two options if you're now in the US, and two different scenarios. If you're somebody who's planning on going back to the UK, either to retire or just to live, then there is an argument for keeping the ISA as it is and just keeping the investments as is. That's not buying or selling. That's just keeping the investments in something along your risk profile where you could just let it grow. There won't be any tax in it because you're not buying and selling. Of course, if there's dividends or income received from any of the funds, etc., if they're not accumulating funds, then there might be tax to pay on them. Alternatively, you could just let them grow, and then of course when you're back in the UK, the ISA is tax efficient. In the US, of course, it's not essentially adhered to the kind of tax efficient wrapper of an ISA. So you either leave it where it is and return to the UK, or I would most likely say your best option is to look at options to liquidate it and move it over to the US as kind of quickly as possible. The more it grows, of course, there's going to just be a higher tax liability to pay. So the quicker you kind of, I think move it into something which is US compliant, the better you're going to be. Alternatively, again, you could look at direct stocks or bonds if your ISA provider allows it, which of course won't put you under those PFIC rules. So yeah, liquidate it, move it over to the US, direct stocks or bonds, or if you're moving back to the UK, perhaps just hold it in the funds that you have been and accumulate them until you get back to the UK. Whistle stop tour of ISAs.
We've got a whole section around SIPs. I'm going to apologise now if you're waiting for SIPs to be answered. There was lots on this, and I imagine we'll probably relocate the SIP topic to our next series of the webinar. So when we get the emails out to you later today, there'll be a link on there for you to register to the next series. If this has been useful tonight or you're enjoying the recording, it'll equally be there. Do please make sure you register for that, even if you can't necessarily commit to the date and the time now, but do register for that. And if you can't make it, you will get a copy of the recording, but we'll have a section on SIPs in the next one, just purely because we're running out of time today. Next one for you, Rob. Again, trying to keep it as short as we can because we've got 10 minutes to go. Can I top up my UK state pension, and what are the implications to consider? It's probably not a yes or a no question, answer this one, but do your best.
Yeah, I mean, short answer, yes. So there's actually a really good process for individuals abroad now to actually top up UK state pensions, and I speak to my clients on every single review and every single person that I speak to that has built up at least 3 years of UK state pensions to look into topping it up. If you're an employed worker and you're abroad, you can actually apply for something called Class 2 voluntary contributions, which are £3.15 per week. As I mentioned earlier, there is a minimum of about 10 years in order to actually get the minimum state pension in the UK. But if you've got 3 years, you can actually top up to those 10 years so that you can actually get the minimum. The maximum is 35 years. So if you have a number of years to go to retirement, you can just contribute on a monthly or weekly basis, or however you want to contribute, in order to get those full years up to as close to 35 as possible. I think not an implication, but something or a deadline that needs to be in people's minds is April 2025. Essentially, April 2025 is a deadline for the HMRC where they'll stop allowing people to actually backdate the years that they haven't paid UK state pension benefits back to 2006. So at the moment, you can actually backdate all your missing years back to there if you haven't actually worked in the UK, or you have, part years pay, for example. You can backdate essentially all the way back to there. After April 25, you're only going to be able to backdate up to about 6 years. So, if you're close to the, retirement age of 67, and, you've still got 10, 15 years of national insurance contributions to top up, and you've been out in the UK for 10, 15 years, then it makes absolute sense to backdate those as one lump sum, because ultimately you're going to get all of those contributions back in the first year of retirement, and then for the rest of your life. So it's a very, very good process that people should definitely get more information on, for sure.
I'm going to go to a question that's been submitted live to go back over a point, Jim, that you were making. This is a question from Peter, who's still in the audience now. Please could Jim clarify the use of the form 3520, the F bar once more, e.g. an example scenario when some or all of these are required.
Great.
Is that something you can expand more on, Jim, please, for Peter?
Sure. Certain pension plans, there are definitions on the U.S. tax rules of what's considered a trust, and a SIP is a trust because it's funded. It's for the benefit of the funds are for the benefit of you, the pensioner. You have a trustee, so under U.S. rules, that is a trust. Foreign trusts by default are to be reported on a form 3520. However, there was a revenue procedure that came out in 2020 that exempts foreign pension plans from these 3520 reporting rules. Because these reporting rules, you'll see if you looked at the form 3520, there's no instructions about how to report a foreign pension plan. So in certain cases, there is this procedure that basically exempts SIPs from filing this form 3520. So there are these default rules. We have this form 3520, which may or may not be required to be filed. We have form 8938 that is filed with your 1040. And that has 2 or 3 pages on how to report a foreign pension plan. So in many cases, the foreign pension plan, the SIP is reported on a form 8938. Since the SIP is funded, it is also under the rules as a foreign financial account, and is also required to be reported on an F-bar. So it's either F-bar and form 8938 or an F-bar and form 3520. And in some cases, there are foreign trusts that are put in place for the benefit of U.S. recipients, so there are some complex rules against that. For that, it's all hinging again on unfair tax deferrals, and it's a whole other regime we have to worry about. But the foreign pension plans typically are either 3520 or form 8938. And that's something we need to discuss and look at on each individual case. Okay, so let's see that we meet the exemptions under this new revenue procedure that came out in 2020.
Thank you. Sonia in the audience has also asked a question. If I sold my property in the UK at a loss, I won't give the numbers and bits and pieces involved in that, but then place it in a UK bank account, what implications about tax in the UK and the US, given that I live in the US? Now, aware that this might be pretty specific here, so if we can't answer it in the next few minutes, please be honest, and perhaps we can reach out to Sonia directly post-event. But if there is a simpler answer for the audience, please let us know.
So I guess first, you would report the loss on your U.S. tax return, ensure that it is a loss for U.S. tax purposes. And then essentially what you do with the cash will not, if it's in a brokerage account and it's earning investment income, that investment income would be taxable income for U.S. purposes. So that would be later reported on your form 1040. So those are the tax implications for the property being sold at a loss. If it's an investment property, if it's a personal home and it was sold at a loss, the loss is not deductible. You could report the transaction, but you would not get the loss because it's a personal use property.
Great, well, thank you. Now, I must state here again, I apologise that we haven't got to all the questions. So, Stephen, you put a few questions live in the event. Apologies that we haven't got through to them today. We've also had questions that have come in from Adrian, Mags, Paul, Mushish, Connor, Sib, and Andrew, which again we haven't got to today, I'm afraid. So apologies about that. What I would ask as a personal favour to the audience that's here today, if you have enjoyed the session as we come to the end of it, please do give some feedback through the question functionality on the software. So if you have enjoyed it, do let us know. Feel free to give us some constructive feedback so we can make these events as useful and as valuable for the audience, because there will be additional series coming up. As we come to the last couple of minutes, I just want to give a moment each to again thank everyone for joining us, and indeed for Rob and Jim for giving up their time. I hope everyone's found this useful and informative and a bit of fun. We've tried to make tax, wealth planning and currency as fun and enjoyable as we can between us. As we come to the last minutes, any leaving commentary or recommendation from yourself, Jim and Rob, to pass to the audience today, please? Any things you'd really recommend or hone in to the audience before we call it a time?
Sure. I would say one takeaway is to be proactive, plan ahead. You know, if you're thinking of leaving the US to retire in the south of Italy or Portugal, let's start planning now. You know, I have a term, I don't like fixing the plane while it's flying, you know, and things have already been done and you can't reverse them, and there's tax to pay. We don't want that. So before you get on that plane, speak with, be proactive and work with a professional like Robert and myself.
Yeah, I mean, it's hard to top that. Goodbye, Jim. But you know, that's pretty much what I would you know, emulate as well. To be honest with you, I think especially when you're dealing with cross-border assets, I think it is important to get some form of professional advice or second opinion. I know as us Brits, we like to think that we can do it all ourselves. You know, me included with a lot of stuff. I'm sure everybody else on this would agree in some form or another. But I think it is always good to get a second opinion, and you know, because there might be stuff there that you know you haven't thought about. When you're dealing with family, generational planning, it's important to make sure that you're not just looked after, but also you know, generations to follow as well. So yeah, be proactive, get a second opinion, professional advice, and yeah, ensure that you're compliant and structured correctly.
Yeah, I'd equally second that as well. We've had many occasions when people have got in contact with us once they've already landed and the implications already happened. I remember cases not too long ago, i.e. this year, when we've had people that have relocated abroad, approached people for wealth planning and tax planning and realised they've already become resident and they've had big tax bills of tens of thousands of pounds as a consequence of, I'll do it later, and that doesn't work from a tax planning perspective. So get ahead of it, get engaged with the right people, have those conversations. Again, as part of this event, we'll be reaching out and you'll have our contact details, and all of us have agreed and pledged to give free consultations to anyone that's watching this. So do reach out to us to have those conversations, to have that discussion for free with no obligation around your personal circumstances and how we can help. But that comes to the end of this first of the series. So thank you very much for everyone's input. Hope everyone has enjoyed it. Thank you again for all the questions and the feedback. And thank you equally to those that have submitted some feedback to us via the question functionality in the report. Again, you'll receive our contact details and we'll be in contact to follow up from it. But otherwise, thank you all and good luck with your planning and journeys and everything that you're going through. But thank you everyone again, and goodbye.
Appreciate your time. Thank you.